one of the fears that I've heard about inflation is that if the value of the US dollar falls, and then let's say the exporting countries that have the goods that we want have economies that are stronger than the United States, then we're at an immense disadvantage in terms of our buying power because we want the cars from China, but we can't afford them anymore at the value of our currency. And presumably we have to print more. And so it creates this accelerating cycle of wanting things that we don't have. And so it's sort of like almost like quasi reparations or like the conditions are similar to the reparation conditions in the Weimar Republic, where you're having to purchase foreign currency and print money in order to be able to do that, which gradually drives you deeper and deeper into this hole where your currency isn't worth as much because the other economies are
Yeah.
doing better than you.
Yeah. Now I could go back to the beginning and unpack each step of the way. You can see it's like one thing piled on another that, there's no, the foundation is made out of sand, quicksand. So, I don't know where to start. Do you have an example of that happening anywhere?
I mean, a better example would probably be chipsets and computer manufacturing, which isn't done domestically. And
Okay. So look, there are strategic considerations where, and there are foreign monopolists of things that you want. So I think oil is a good example where, we burn 20 million barrels a day and we only produce 13 million, even though we're the largest producer. We're still short 7 million, which we import, which is product. You burn product, you produce crude oil. So, but taken together, we're a net importer. And so we're subject to a foreign monopolist if there was one, which there happens to be, and it's Saudi Arabia. And there's not much you can do about that. It's like if you're living in an underground city and you're buying the air from somebody on the surface, an underwater city, and you're buying the air, they're pretty much in a position to dictate price. There's not much you can do about that, except, hope they don't do too much. There's a disparity of power. So just because we have our own currency doesn't mean there's not a disparity of power when it comes to resources that we don't have. And I call all that kind of falls under strategic considerations, right, that are going on. And so what do we do? And then you can say, well, what do we do about that? So if you look at every inflationary period we've had, it's always been oil prices, whether it's the 70s, whether it's right after COVID. Saudis immediately raised the price of oil to 120. Cover was the Ukrainian war. We had that big spike. As soon as that went down, our inflation rate came back down. It's still higher than it was before. Prices are still higher. It follows that too close for comfort. It's not perfect following, but it's very close. And you can look at 2008. That was preceded by the Saudis raising price up to 155 until the economies crashed. We were vulnerable because of our low deficit and our leverage, but that was the catalyst that brought it down. And in 2000, the same thing happened. And of course, in the 1970s, oil went from 3 to 40. That's like over 10 times move. That's like going from 70 today to 700. And we wound up crashing, after that. So, and again, I have more details of what happened there, a narrative that differs very much from the whole Paul Volcker story again. But, so what do you do about that? Okay, if the Saudis raise the price, and I can give you the detail. You want the details on how they do it?
Yeah, sure.
They do it. Okay, takes a minute. I know you have limited time. They I'll use round numbers. They're not that far off. The total consumption is about 100 million barrels a day, crude oil, and the total production is, the total sales are 100 million. Inventories are pretty, stay reasonably constant. There's seasonal adjustments. So it's 100 million produced, and the only country with excess capacity that could raise their production tomorrow is Saudi Arabia. They could go from 9 to 11, let's say, an extra 2 million if there was demand. And the first thing that tells us if you understand markets, is that everyone's selling at the market except the Saudis. Everybody's selling all their production except them. They're acting as a price setter. They're setting a price and then letting their sales adjust to whatever the residual demand is. People are buying the other 93 Yeah, but I think they actually export about 7 million. So they're buying the other, and so we'll assume Saudis aren't using any of their own oil, just for this example. They buy the other 90 million first, or 91 million, whatever the price. But then for the last million, they have to come to the Saudi. The last 9 million, they have to come to the Saudis. So they have their total of 100 million. And you only have two choices. You either pay the Saudis price, or you have to shut your lights off at 3 o'clock in the afternoon, right? Because you can't like change your consumption on any given day. It's all rigid. It's not a market that's infinitely flexible, like would be needed for prices to be able to adjust like they do under perfect competition. That assumes infinite buyers, infinite sellers, and adjustments and all that. What we have in this market is kind of a fixed demand every day of 100 million, which can't be modified. Somebody's not going to not drive home from work until the price of gas gets really high on his way home. Okay. So it's kind of a fixed demand and excess supply. So 100 million demand, there's 102 million in supply. If you just let supply, they just tried to sell the whole 102 million, the price would drop low enough till somebody stopped producing. And if the Saudis didn't sell their last 10 million, the price would go up to whatever, 300, 400, 500, until somebody didn't drive home from work, whatever it takes to cut consumption that day. So it's called inelasticity. In the short term, it's inelastic. The supply and demand don't change. So it would be simple enough if the Saudis just said, we want $80 a barrel. And then that would be what the price was. Because you couldn't buy it. You couldn't buy that last so many million that they sell at the end of the day if they, from anybody else. It's not there. It doesn't exist. We have to pay that price. If there was enough supply elsewhere so we didn't need their oil, yeah, then the price could drop. Okay, and the price can't go higher than that because they'll sell as much as you want at 80. They've got 2 million extra supply. The world can't take that one day. It can take a few 100,000, but they can't. So the price won't go above 80. So they would just set the price at 80. And I'll give you another analogy in a second, but I'll finish this one now. But they don't do that because then they'd be accused of price setting. But that would be the way a normal swing producer would set the price. And the Saudis they don't have much choice. They just try to sell everything like everybody else. The price goes to zero, which we saw a few years ago. It actually went negative when there was an excess supply. Okay, because at that point, the market didn't need the Saudis' oil and everybody else just tried to sell everything and it went to zero. Now, Russia today could do the same thing. Russia can get any price for its oil it wants. It might sell a little bit less, but not a lot less. Because every day the world needs 100 million barrels. It's getting 7 or 8 million from Russia. If it raised the price to 120, we either have to pay them the price or shut off the lights. They don't know that. So anybody thinks they're savvy as to how the oil market works is completely wrong. They're in the dark just like the rest of these people. Because the Saudis have thinly disguised their price setting enough for these people like Russia to not understand it. Because if they did, they would. Okay, and so they don't. So what the Saudis do is they set what's called their OSP. It's their official selling price. And instead of setting a price like 80, they set an incremental price over what's called a benchmark. So every day they publish benchmarks, or benchmarks are published like Brent North Sea crude, West Texas Intermediate, Dubai Light, or something. What these are reports of the price of that these grades of oil sold at yesterday. So yesterday's closing prices for all these different grades of oil, and there's an averaging in there to smooth it out, so it's not too volatile. But it's basically a report of prior prices. Saudi oil has a certain sulfur content, so it's worth either more or less than any one of these grades. If the Saudi oil has more sulfur than North Sea Brent, then it's worth a little less. If it has less sulfur, it's worth more because sulfur is there's a cost to refine it out of the oil. Okay, so there's a fair price for Saudi oil versus these where you'd be indifferent between buying North Sea Brent or buying Saudi oil. If the Saudis set their price at a premium to that fair spread, let's say a $2 premium, let's say the fair spread happens to be zero and they set their price at $2 above Brent, it sets an upward dynamic in place for price. Because now nobody's going to buy the Saudis at $2 over Brent because it's not worth it. It's only worth even. So they'll buy everybody else, but then from everybody else, but then at 3 o'clock in the afternoon, they have to start looking at this Saudi oil, whether they like it or not, or shut the lights off. And so they start paying everybody a little more, trying to pay, they'll start paying them. If everybody was at 80 and the Saudis were at 82, they'll start offering them 80 and a half, 81, 81 and a half, 82. They still don't want to buy from the Saudis because they hate them. They don't want to pay their price. But then when they get to 82 and a half, they'll stop and they'll go and buy the Saudi one. Then they'll get their 100 million barrels and then everybody goes home. And the Saudis sold their oil at their $2 premium. And they set premiums at last month and they've sold all their oil at that premium. The next day, where is Brent going to be? Well, they look at the previous day's trades and they see it went up to 82. So, now Brent's up to 82. Okay, so now the Saudis are at 84. So the same thing happens again. Now, it doesn't take just one day because they have averaging and this type of thing, but it creates this relentless upward force. And you can see when the Saudi OSPs are at enough of a premium, there's this upward trend in the price of oil. You look at the chart, and you can see it. It's like a straight line. And it'll go down once in a while because there'll be a scare, peace in Gaza, Russians increase their this is like news in the world. And there's plenty of massive speculators that will sell oil short and drive the price of the futures down for a couple of days, and then they'll go up and might stay, whatever. So you get volatility. I'm not saying it's perfect with no volatility, but underneath it all, they are controlling this price, whether it's going to be on an upward slope or downward slope, by setting their OSPs at either a premium or a discount to the price of oil. And so we have this external price setting, and most of our inflation, what's called inflation or shifts in the price level, have occurred for that because of Saudi's influence on oil prices and what they've done. They took over pricing in 1971 from the Texas Railroad Commission, which used to do this with the West Texas companies, to Riyadh because we ran out of excess capacity. The world was buying all our oil, and the Saudis became the only ones with excess capacity. So they took over that role, and instead of keeping oil at $3, where we did for 15 years, which was our 15 years of our best stability ever, the Saudis had different ideas other than American stability, and over the 10-year period, took it up to 40 before demand collapsed in a huge recession, and they couldn't do that anymore. The demand fell so far that nobody needed their oil at all. But demand came back over time, and now they're back in the driver's seat doing what they're doing.